I was recently asked how I use unusual volume. Well, last Friday, Medicaid and Medicare managed care provider Centene traded unusual volume, and we're going to talk about that and how I think about it. Also, when exactly are Tesla's next earnings going to be released? There seems to be a difference of opinion about that on the street, so I'm going to tell you the way I see it today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and welcome to Open Mic, sponsored by OptionPlay. So, very recently, somebody was asking me how I think about unusual volume, and I thought we might actually take a look at some unusual volume that I saw last Friday as an example, and what the catalyst is that the trader who put on this trade might have been looking to. And this is sort of one of those things where I think if you have access to unusual volume, and a lot of brokerage platforms do offer it now, you want to start thinking about what it is exactly that somebody could be betting on. So with that in mind, why don't we first just take a look at one of the sources that I use. So I'm just going to share my screen right here. And we're going to take a look at last Friday's unusual volume. Now, I realize this is kind of hard to see. Because this is kind of right, this is my Bloomberg screen for what it's worth. So anybody who's unfamiliar with what a Bloomberg terminal is, it's a data aggregation service. It's used by a lot of institutional traders. I would say it's probably the most common data aggregation and querying and trading tool that's used by most institutional participants in the US. And what this screen is just an unusual volume screen. And I can put different filters in and just say, okay, what has traded above average volume on a given day? This is, as you might or may not be able to see this is as of last close, so it was going back to Friday. And the second most active name on this list is Centene. Don't ask me why this caught my eye, but it did, just because I happen to be looking at the managed care space a little bit. And what I noticed is it traded about 7.5 times above its average daily call volume. So it normally trades about 1,136 calls. And last Friday, it traded 9,650. So I became curious, okay, what exactly was that all about then? And so I basically, once again, winding back the clock, and I could see that 3,000 of the March 22nd weekly 82 strike calls traded, and 3,000 of the March 82 28th expiration 82 strike calls traded. And then I just went delving into a little bit more. It's not super important. You can use your brokerage tool to figure this out however you want to. But basically what I figured out from that was that the March 22nd weekly calls were sold at $1.20. And the 22nds were sold at 35 cents, and the 28th were bought for $1.20. So now we can just switch over to the OptionPlay app and just take a look at what that trade actually looks like. So I'm just going to go in here and put that trade in, and we can try to get a sense of what was going on. Now, bear in mind that this is not going to reflect the prices that this institutional trader used. I'm going to get to what I think they're actually betting on and how we can think about trading it ourselves. So, like I said, they bought the March 28th weekly 82 strike calls 3,000 times, and then they sold the March 22nd weekly 82 strike calls also 3,000 times. Safe bet this is basically an institutional trade. What you end up with is a trade that looks a bit like this. So the ideal circumstance is essentially for the stock to land on that strike at expiration. So it's a very targeted trade, and with a very specific time frame in mind. So in this case, March 22nd. So looking at this trade, I thought, well, is it likely that this trader is really targeting $82 by March 22nd expiration? which is a very narrow bet to make? Or is it more likely that they just want to make sure that they own those March 28 calls and they're figuring that the stock has little chance of getting up there for now, and this is just going to help them pay for them in the meantime? And if that's true, why does March 28th matter so much? So let's just talk a little bit about how I knew that they were selling the March 22nd and buying the March 28th. So I just went back and I looked at the tape and I saw that basically those March 22nd 82 strike calls traded much closer to the bid and at a lower implied volatility than the 82 strike calls that I believe they were buying, which traded very close to the offer and at a much higher implied volatility. Let's talk a little bit about what Centene is and what could be going on here. So Centene, for those who don't know, is a managed care insurer. And I'm sure a lot of people who are viewing this are familiar with companies in this business. Probably they're more familiar with those companies that provide these services to individuals or to corporations. Maybe the best well-known of those is a company like United Health. So Centene's niche is that they provide these services on a contract or a subcontracted basis to states, primarily for Medicaid. So 65% of the company's revenues come from contracts with the states, managed care services for Medicaid insured. And then there's a smaller percentage that is Medicare and a very small percentage after that. So it's about 65% Medicaid, it's about 15% Medicare, and the rest of their revenues are basically going to be, corporate individuals, stuff like that. So what is interesting about this company from a fundamental point of view, and then we can actually come back to my other screen and we'll just take a look really quickly at this, and it's just going to be a chart, so we don't really need to get a really good view. But what I'm going to show here is a historical chart of the company's price to earnings. So I'm just going to get rid of the price. So the price to earnings is this number right here. And we can see that the price to earnings is extremely low. It's about 12.7 times earnings. Now, why do companies trade at low earnings? Well, one reason could be that the companies aren't growing. If you don't see top line growth, or if you see declining margins or things like that, those would all be good reasons to trade at a low multiple. But the thing is, that is not the case for this company. So if we take a look here and I just say, okay, well, what's been actually going on with revenues? Revenues, this is just the last 5 years now. I'm going to blow that up a little bit. Revenues have been growing and fairly substantially. In fact, we can see that over the last 5 years, revenues have more than doubled. Oops, that says net income, but just trust me, that's that's just because this is my own spreadsheet and I didn't label that. I can change that, and I'm going to, so that we don't get confused. That's actually revenues. So if revenues are going up, if they've doubled in 5 years, it's not trading 12.7 times earnings because it doesn't have any top line growth. Well, what else could be doing? Well, I mentioned margins, for example. Maybe the company is not, they're growing their top line, but the bottom line is shrinking. Well, it turns out that's not really the case either. So we've seen about a 93% increase. So 2019, $3.92 a share, $6.13 a share for the last full reported quarter. So that's not the issue. So a reasonable question we should be asking ourselves at this point then is, what is the issue? And we can go back to the OptionPlay app here, but we're just going to talk about that a little bit. So the bad news about being a company that does contracts with states is you can lose those contracts. And in fact, they did lose one recently. So I think they lost about 2/3 of their the size of their Medicaid contract in Texas recently. And at least one analyst has speculated that perhaps the company has lost some of their political clout or traction. Now, the company also made an acquisition a while back, and as a part of that acquisition, they had acquired businesses in Florida and Georgia. And Now the concern is, well, they lost contracts in Texas. Might they lose them in these places? And it turns out that Florida has said that they are going to announce essentially what is going to go on with the contract for Centene there on March 25th. Well, fancy that. March 25th is right between the 22nd expiration 82 strike calls that institutional trader sold and the March 28th 82 strike calls that trader bought. So without earnings, which they're not going to be reporting until April, they already reported, and with the Texas news behind us, it seems reasonable to deduce based on what we know is going on with the company. So we know that the company is trading at a very low PE, despite the fact that it has solid top-line growth, in theory, and decent EPS growth. We know that they've reported earnings already, and they're not going to be doing another one until April. And we know that there are concerns that they could lose contracts in other states. So if that's the case, then the strategy that this trader put on begins to make a whole lot of sense. Because now what we can see is, all right, well, by selling the March 22nd weekly 82 strike call, a call that's not likely to go into, is the stock going to take off before we actually find out the status of what happens with their Florida contracts? Probably not. So you can sell that 82 strike upside call with some impunity to help finance the purchase of this longer dated one on the 28th. And that's what I think is going on here. I think that there's a trader who's decided that they were going to risk a relatively modest amount to essentially make a bullish bet that possibly Florida's not going to drop them, and which seems to be broadly expected, and that they're going to get a pop coming out of that. Now, I am not an expert on Florida politics or Medicaid managed care contracts, but what I can say is that the options trade does make some sense to me. It also makes some sense to me that if you happen to own Centene, and perhaps several of you do, you may want to think about what you want your position to look like, knowing now that you've got this upcoming catalyst that could affect things. So let's just talk about that for a second. Let's say that I'm going to just open up a new tab here, and let's just say that you happen to own the stock, and you know that's happening. One thing you could certainly do is you could say, all right, well, I want to be insured in case something happens. So you can insure that with a put spread. And I'm just going to say, you could just go to that week because we know when the news is, right? So maybe you buy the at the money 78 strike put and, sell one that is a little bit slightly out of the money here. We could, let's see here, do something like, we've got 78, 75. I've got to make sure that I'm matching my expirations just for simplicity. Now, this stock is already pretty cheap, so you're probably not going to need to. You're not going to need to, go too far out of the money. The stock's not going to go to zero. It's already pricing in some bad news. That's what that 12.7 PE tells you. Is that clearly a lot of people on the street. And think about it. I mean, United Health is trading, 22 times earnings. So you've got a company that has managed to double their revenues, nearly double their EPS over the course of the last 5 years, and is trading 12.7 times. People obviously think there's something wrong. You want to own the stock. You don't want to sell it. I completely get that. But maybe you want to just give yourself a little bit of protection in and around that event. So, you could sit there and hold on to your stock, maybe buy a 77, 73 put spread, something like that. What else could one do? As an alternative to buying this call calendar, which, by the way, I don't object to this call calendar. I think the call calendar is fine. I would offer this one quick caveat, and I think that's kind of important. I want to just see how these prices close, because one of the things I noticed when I was looking at this is that some of these option spreads were, a little bit wide. They don't seem too bad to me now. The March 28th weekly 82 strike calls closed 55 bid at $1, 45 cent wide on a call at 60 cent option. So if you want to put on this call calendar and follow the 3,000 lot, I think it's a fine trade, I have to say, if you're inclined to make a bet on that same thesis. The weekly 22nd 82s, by the way, those went out 20 bid at 75. So very, very important point here. Cheap way to make a bet, sell those weekly 22s. I don't think the stock's going to blow through that strike because everybody's kind of waiting on this news. Is it possible it drops early? I suppose. But an important point, if you put this trade on, use limit orders. Whatever you do, use limit orders. What should that limit be? Well, the way I like to do things is typically I'm going to look at essentially the midpoint on the bid-ask average if I'm not, modeling out the value of the option. I'll start there, or maybe even slightly below the midpoint if I'm a buyer, or slightly above it if I'm a seller, and I'll walk it in. So in the case of the March 28th weekly 82 calls, those are 55 at $1, right? So we'll just call the midpoint, just to keep the math simple. We'll say it's 75 cents, something like that. Maybe I would start 70 bid. So I'd bid 70 for those, wait, walk it up, 80-cent bid, and see how it went. And give yourself a little bit of time. If you're using the complex order book, so you're using something in your broker platform that allows you to enter a bid on one side and enter an offer on the other, and you're thinking about using the same technique, bear something else in mind. A complex order is not reflected live to the screens. So it's not getting essentially as many eyes on it. It's only just being looked at essentially by an electronic eye by the market makers who are looking for VIG in that area. But sometimes the best way when you see these spreads are a little bit wide, if the stock's not bouncing around, and this stock only moved 11 cents today, so it's not like the stock's moving all over the place. Take the side that you're going to buy, work that side first, start in the middle, walk it up small. When you get filled, then you can go back to the other side, sell that, and do the same thing. Start in the middle and walk it down in nickels. And so this is indeed the kind of thing that if I'm looking at unusual volume, and I do care about unusual volume, but just because I see calls trading doesn't mean, oh, calls are trading, so therefore I'm going to go along. I want to know what people are up to. Why are they doing this? And nowadays with weekly options, you can really see precisely the dates that people are looking for. Use your Google machine. What's going on with Centene? What do we care about on that week in March? So I think this is one of the ways that I most certainly do use unusual volume. So it was actually sort of in the context of things that are unusual that I also began to think a little bit about Tesla. So what happened in Tesla? Everybody probably has different data sources. Again, I happen to be using Bloomberg. And we'll go back to this screen so you can take a look at it. This is just something that gives you the past earnings. So I can put any stock in here. I can see what the past earnings were. And it just tells me the anticipated date for the next earnings, right? So these are all the past earnings. This is how much the stock moved the day after they reported. And here I can see, okay, so Bloomberg is forecasting that they're going to report their next earnings on April 19th. And as soon as I saw that, I thought, Bloomberg's got to be wrong. Why did I say Bloomberg's got to be wrong? Because if you trade options, chances are that April 19th is regular way expiration for April. And what happens? When do options expire? On Friday. And Tesla typically reports after the close. So this is telling me, or Bloomberg is telling me, that Tesla is going to report after the close on April 19th, on a Friday after the close? Yeah, I don't think so. The only company that I can think of that always reports at a kind of a really unusual time relative to every other publicly traded company, they report their results every quarter, is Berkshire. Berkshire reports their results on Saturdays. So what is going on here with Tesla? Why does Bloomberg think it's going to be on April 19th? They're not going to report Friday after the close. That's not the way this works. So chances are they just have an algorithm. And it's probably saying, oh, well, it tries to match what it did in the past. And sure enough, when they reported the same quarter, Q3 last year, It was on April 19th. So it's a throwaway date. Oh, they reported April 19th last year. They're going to do it this year. What's actually going on? Well, it turns out that what this company actually does is they report these earnings for this quarter on or about that third Wednesday or so, third, fourth Wednesday of the month. So this is the Friday that Bloomberg's forecasting right now. So I go back in time, and what do I see? Out of all of those same quarterly results, I've got May 8th, that's a Wednesday. May 7th, that's a Wednesday. May 6th, that's a Wednesday. Go all the way up this list. What am I seeing here? I'm just going to blow this up so you guys can get a better peek. That's over here on the right. So what I'm really interested in is, okay, so when they report their earnings, what's the pattern? Is it the 19th? 19th isn't the pattern. They're reporting these things late April, early May on a Wednesday. So that Wednesday, the week that expires April 19th, that Wednesday would be the 17th. That would be the earliest that they ever dropped earnings going back 10 years for that quarter. Is it possible? I suppose. So number one, I think Bloomberg's got this one wrong. I was speaking to a colleague. They were using some source, I think, called Wall Street Horizons or something. I'm not familiar. Maybe some of you guys are. They were forecasting that they were going to report, I think, on the 17th. And that's probably because they're looking at this Wednesday thing. My suspicion is that they're probably, just based on this pattern, because it's only estimated. All these guys are just estimating when these earnings are going to come out. My guess is that they're actually going to report the Wednesday following. All right, so that's not going to be April 19th. You know, we're going to be looking at the 24th, the following week. So where else did I decide to, what else caught my eye about this that made me suspicious in this data at all? So I was taking a look at the price of Tesla options. I was looking at the term structure. What is the term structure? That is the price of options that expire this week, next week, the weeks following, going out in time. And I was very interested to see what the price looked like. So in white, this chart that we have here, this is the price of options. These are the ones that expire at the end of this week. Those are the ones that expire the following week. Here we have March 28th, which is my sister's birthday, by the way. Happy birthday to Larissa when that comes up. This is April 5th. This one here is April 12th. Now take a look. So now we've got this one that is April 19th. So that's the day that Bloomberg and a couple other sources think that earnings are going to come out. Well, it would make sense for options that capture earnings to be more expensive than options that don't, right? If you're going to buy insurance, you want to buy it before and capturing the event. You don't want it to expire before the event takes place. But then take a look at these ones from April 26th. So those are higher still. And in fact, other than those expiring at the end of the weekend, it's been a volatile week. So we're going to throw that out for a second. April 26th, those are the options that have the highest implied volatility. So this is another way the options markets can give you some sense. Now, Susquehanna, Citadel, all of the options market makers, all the people that wear the hat that I used to wear, are they right about this? Well, I've already described one of the reasons why I think they could be right. But taking that information in conjunction with the fact that, I don't think they're going to be reporting Friday, April 19th after the close. You put all that stuff together, and I actually think that there are some people who are getting this one wrong. So that's really important. Look, Tesla is one of the most actively traded single stock options there are. If you trade options, there's a decent chance that you trade these. And interestingly, we actually had positions on the April 19th. We were actually long the April 19th expiration. And I directed one of the guys, I said, blow that out. You're going to be long Tesla. We need to get on the long side of that event. So I have no problem selling near dated premium against it. I actually think that's probably an attractive calendar. to be long April options, April 26 expiration options, and short the April 19th regular way options, because I think that those who believe that it's going to report that week are probably wrong. And if you're long that calendar, what's the most you can lose? It's however much you spent for it. So what is that? Let's actually take a look at that. How do you trade that? So here we go. This is thinking out loud time when we try to take information that we see and think about it intelligently and say, okay, well, what can we do about that? So normally, you would expect a much bigger gap in the implied volatility between these options. So once again, we can take a look at a calendar. I could say, all right, well, I want to buy the ones that capture earnings. That's the April 26 calls. And I want to sell the ones that don't. That's these. Doesn't matter. I've got puts, calls. When you're trading a calendar spread, as I'm going to show you in a second, almost doesn't really matter which one you do. So I get a trade that looks kind of like this. We'll blow that up. That's where that's going to profit, like that. Okay, now I'm just going to modify this thing again and just show you that if I used calls, look, doesn't look any different. It's basically the same trade. Now, I will tell you that my sort of favorite trade going into events is actually to own two events and be short the first one, because I want to play for a little bit of vol crush. So what might that look like? Well, now I've got to be a little bit more creative. So I would say, okay, and I think this is kind of the opportunity here. I want to own two sets of earnings in Tesla, and then I want to short the false earnings. And then when that comes off, I'm going to turn around and sell the real earnings. So what does that look like? Okay, so let's assume I'm right, that they are going to report Q1 24 earnings on, say, the 24th of April, so that Wednesday. And then we go further out in time and we say, okay, well, their next one is probably going to be out to July. Also around the 19th, we look to July expiration. I'm going to just modify in here. And you can actually, if you don't know when the expiration is, it's pretty easy. You can just go into here if you have this. And turns out, so that is also a Friday, interestingly enough. So you could go out to the July 19th earnings, July 19th expiration, hoping to capture earnings, or maybe something a little bit longer dated. The idea being that that's going to preserve some of that optionality. Now, I actually suspect that if somebody begins to recognize that, hey, the 19th is maybe not that day, that they might then realize, hey, well, maybe July 19th isn't that day either. So I can go to August. Now I know for sure I'm capturing the next two earnings. So maybe buy the, a 40 delta option or even a 30 delta option, whatever matter. So I'm just going to, nice round numbers. I'm going to pick the 200s. First things first, sell some near dated premium against that option. We get a shape that looks a little something like this. Now you'll notice that those break evens are much wider now. And the idea is own that upside call, finance it by selling this other sort of lower strike call that actually is, in my view, going to expire before earnings. Bloomberg thinks it's going to capture earnings. I'm going to say it doesn't. Now, even if Bloomberg is right, I should still do all right with this strategy. But if they're wrong, I can actually do this trade, and then when that Friday comes along and everybody says, hey, wait a minute, and actually the vol's going to get sucked out of this the minute they announce when their earnings really are. So they're going to come out. Company's going to come out and say, we're going to release earnings, and they're going to tell you what the day is. If it turns out to be the week of April 19th, it's still a higher implied volatility than that longer dated one. So, I was wrong about the timing on earnings, but I'm still going to do okay because there's already some event variance built into it. But if I'm right, the vol on those April 19th is just going to get crushed. And then I'll just cover those, and I'm going to switch. And now I'm just going to say, okay, fine. I'm going to get short these weeklies instead. So you can roll it. So these are, I don't really hear people talk about this kind of stuff too often. And, we typically think about trading volatility as much as anything else. But it does point out that, number one, the options market can tell you essentially that there are events coming up that you might want to pay attention to. Unusual flow can do that. Unusual options pricing, like what we just saw in the term structure, can do that. And sometimes you'll see that the price is unusual, and then you look at the underpinning data, and you're going to draw your own conclusion and say, you know what, that actually doesn't make a whole lot of sense. Companies don't typically report earnings. What do companies report Fridays after the close? It's always some kind of bad news surprise. Right before everybody's left the desk, they've gone home, nobody's paying attention. That's when they want to drop that. But scheduling earnings for a Friday after the close, that's not typically the way these companies are inclined to operate. Okay, so if you are watching this on YouTube, then you can leave your questions and comments in here, and I will attempt to answer them. And so let's just talk about this. And I'm going to try to go in no particular order. So first things first. OptionPlay shows earnings for Tesla to be on April 17th. Okay, well, actually, that's an excellent point. So we didn't even bother to go into the strategy checklist here for this one, but that's obviously something that you want to take a look at, which is when are the expected earnings. So I guess OptionPlay and I have we got a little friendly wager going here on this one. I think it's going to be the following week. Could I be wrong? Absolutely. You guys saw the logic that I was employing to get to where I was. The subsequent week implied volatilities were even higher than those of the 19th. The 19th is actually the earliest in April that they have reported, going back for more than 10 years. And it looks like it's generally around, they report on Wednesday. So it could either be Wednesday the 17th, which would be very early for them to report, or it could be the following week on the 24th. I think the 24th is the number. And I'll be the first one to issue a mea culpa if OptionPlay and some of these other folks are right and I'm wrong. But there you go. I bet with somebody else today actually about this. So, and I took the 24th. But these trades that I was just outlining, they'll do fine either way. All right. What do you think? Did I share this? I think so. What do you think of an April 12th weekly 148, no 15th, 130 poor man's covered call on Google, aka Alphabet? All right. So for anybody who doesn't know what some people refer to as a poor man's covered call, basically you're selling calls against other options that you own. So rather than owning the stock and selling calls against it, you own longer dated options and you're selling calls against that. What are the benefits? What are the drawbacks? So benefits first. One of the things is that if you own a longer dated call, so we're just going to go into this one right here. By the way, there's two ticker symbols for Alphabet. One with an L, one without. One with an L is voting rights. If you really care about that, you can buy that one. If we're talking about it, I rather like it because I still refer to the company as Google. Okay. So what might a covered call look like? Let's start with that. So a covered call, you buy the stock, and we're actually that's not right. We're going to buy the stock, and then you sell a call against it. So that's a covered call. We're just going to put the mid prices in here. We'll go out this amount of time. Stock's about 137.5. I would usually want to sell a call that is slightly out of the money because presumably you own a stock so that you get some capital appreciation. You're selling a call simply so you can collect a little bit of incremental premium on top of your stock. Now, there are some people who, if you've held a stock for a long time, will then start writing very tight strike call options usually because they were otherwise looking to sell the stock. So they can actually use it as an exit strategy. I bought a stock at 100. You're selling 2.5% to 5% out of the money calls every 30 to 45 days. Let's say stock gets up to 150. That's your target price. Now you just start selling at the target price, saying, if I get taken out here because this is as high as I thought the stock was going to go, that's fine with me. If I don't, I'm going to collect premium. That's also fine with me. There are some institutional hedge fund managers who have implemented this strategy. I think most famously would be Leon Cooperman. He's a former Goldman partner who started Omega Advisors, and this is something that I know that he has done a lot of. And a lot of people will actually also sell cash-covered downside puts at entry points for stocks. So they sell calls at places where they want to exit stocks that they hold. They sell puts at levels where they would be happy or willing to enter stocks that they want to own. So that's a fine strategy. Okay, so covered call. Own the stock here, sell an upside call. Like I said, give yourself an out of the money strike to try to collect. Couple things about this. When you buy stock and sell covered calls against it, you are taking equity risk. Because if the stock goes down, you own the stock. So you're going to have some offset from the call you sell. But you are taking equity market-like risk. So I demand an equity market-like rate of return on covered call trades. What is an equity-like return? Well, it actually is going to vary a little bit from one stock to the next because some stocks are considerably riskier than others. But in general, if we consider that we might expect to get, let's say, 12% a year out of a long equity portfolio in the S&P, well, if I'm going to sell premium, I'm looking to get those types of returns. So what does that mean? Well, I'm hoping to get, on a risk-adjusted basis, something like 1% a month. That would be a very attractive additional incremental source of income if I could get it. So here you have an option that expires in 46 days, so that's a month and a half. So what am I trying to get? About 1.5% of the current stock price of 138 is going to come out to a little over $2. By the way, anybody who has ever traded on the options floors, every one of them probably still totes one of these things around. I have this one, HP12C, and I have an HP12C Platinum around here, and that is because we used to program our options models into this. The difference between this and the Platinum model is that I think the Platinum model you can put in a 137-line program. Okay, so where does that get us? I'm trying to sell an out-of-the-money call. I don't want to be assigned. I'm looking to get a little over $2 for the thing, and lo and behold, here we have the 150s. Okay, so I could do buy Google, sell the April 26th weekly 150 call, collect 238. I'm getting better than 1% a month. I still have a decent amount of upside up to 150. Stock closed 137.67. So that's going to give me, almost 9% of capital appreciation potential plus the 238. Now, sometimes I like to look at the premium over the strike. Other times I'm just looking at it over the stock price. That's 1.7% on top of the 9. So basically, that's 10.5% is my max possible gain. And then I'm collecting, a little over 1.5% yield. So that is a covered call. Poor man's covered call. Well, we're not buying the stock. So I'm actually just going to go into another tile here and say, okay, instead I'm buying a call. And the one that he talked about was the November 130. So let's just stick that in here. What does that look like? So November 130 call. One quick point about this. Notice anything about this call? Those paying attention? Maybe we can flash up a definition of this. In the money. This call is in the money. Stocks closed 137.67. So the 130 call is in the money. So it's going to behave a lot like stock does. So, and then he's looking to sell the April 12 148s against it. So we're just going to sell April 12, just go over here, 148 calls. And what does this thing look like? Okay. So that looks a little something like this. How do we feel about this? Well, first things first. we just talked about how much premium we hope to collect just for taking equity risk. And I'd indicated that, I like to see at least 1% of the stock price per month is sort of a rule of thumb, but it depends on the riskiness of the stock and a couple other factors. This is pretty close, right? So he's getting about $1.20, and that expires in about 1 month. So it's maybe a little less than I would normally target, but it's not bad. And we can actually calculate what the delta of that option is. So if it's a 20 delta option, which is what it appears to be. So the delta is another way you can sort of think about the probability of assignment. So 80% chance it expires, worthless. That's not bad. And the 130 calls. Okay, how do we feel about those? Well, my only comment about that, I don't mind it terribly. One of the reasons people like to use in-the-money calls rather than at-the-money calls for trades like these is often because you're spending less extrinsic premium. So that's extrinsic premium is going to be defined as the amount that you're spending on the option in excess of its intrinsic value. This is in the money by $7.67. Stock close 137.67. Deduct the 130 strike. That gets you to 7.67 of intrinsic value. Extrinsic value is anything and everything above that number. So in this case, it's $20.70. Deduct the 7.67. You're looking at, in round numbers, $13 of extrinsic value. So a decent amount, right? In fact, it's 13%. It's 10% of the strike. So $13 of extrinsic value. So that's the optionality there. How much extrinsic value is on the at-the-money options? Like the 140s are as close as you're going to get. So the 140s have about $14.55. That's not that much more extrinsic value. I wouldn't feel terrible about doing that. Now, an important point also is that, so what's the benefit of spending less by doing something like that? Well, one is that if the stock really falls out of bed, you're taking less risk, because in any of these trades, assuming you take the thing off at expiration, the most you can lose is the premium you spend. So in that other example, you're buying something for $20, you're selling something else for $1. The most risk you're taking is $19 per share times 100 shares. It's $1,900. That's okay. I don't mind that. I like Alphabet as a stock. I feel like the stock's been pretty badly beaten up. They've obviously had this controversy about Gemini and some other things that we've talked about recently. People are concerned about ad spend. I get it. But this company is pretty reasonably priced, I have to say. Let's take a look at what multiples we're looking at right now. So we're looking at probably full year earnings estimates of $7.05 a share versus 137.67 stock. So 19.5 times earnings. That's 15% year-on-year growth if they achieve it. Similar growth projections for next year: $8.10, $90 billion in free cash flow, full year 2025. That's cheaper than the market. It's cheaper than the market, and the market is not growing at 15%. So I like your trade. You can be flexible with the strike. I think it's all good. Okay, so what about this? I have a question here. What about exploding IVs, implied volatilities, from Rob Pod? So I'm not 100% sure what security you might be referring to, or in general. If the question is, can you look at exploding implied volatilities as a sign that something was going on? The short version on this is absolutely yes. If you see implied volatility going through the roof and you're just thinking that's an opportunity to sell it, think again. Every single time I see a price that doesn't make sense to me, and actually Centene Health was a good example. So I was thinking, This thing's, it's growing the top line pretty effectively. It's growing the bottom line pretty effectively. They have government contracts. That seems like a relatively stable business. It's trading 12.7 times earnings. What's going wrong? Well, this is a clear buy. Well, no, the 12.7 price to earnings by itself is a warning sign that something's going wrong. And it turns out that what's going wrong is that government contracts are nice when you have them, and when you lose them, you lose a lot. So all at once. Okay. Mike, can you talk about the CRM trade you put on a few weeks ago? I followed with buy 300, sell 330 calls, sell 280 put. Are you keeping it on or taking it off? When would one decide to sell? Okay. So let's just take a look at, I talk a lot, I remember little. So let's just take a look at CRM. So the deal with CRM, with Salesforce, was we were taking a look going into earnings, which they reported on the 28th, and the stock did pop a little bit. So typically when we do earnings trades, and we'll go back into the OptionPlay app, because I think this is actually probably an easier place to illustrate this. Now, unfortunately, I can't wind back the clock and go back to what we were seeing at that time. But we can basically sort of take a look at how the stock's been trading over this period. And so we're back over here. This was the pre-earnings period. We were making a bullish bet on it. So what we were looking at was something called a call spread risk reversal, buying the 300, 330 call spread, which I can put in here. And like I said at the time, we try to do these trades for something pretty close to even. So that would be buying the 300 calls, selling the 330 calls, and selling the 280 puts. And we're not getting any elaboration here on what price he got this thing on. But this trade is now in the money. It's now worth $926 if you did this expiration. I'm not sure which expiration you chose. But I will say this, that when I'm playing something going into earnings, I usually am looking to play it until at least 3 days after. So a lot of people will refer to the 3-day rule. I've heard, Steve Grasso, he's a floor guy. He's a New York Stock Exchange guy on fast money all the time, and he's not an options guy, but as an equity guy. Everybody I know sort of thinks about this 3-day rule. What are we really talking about? It's not a rule. It's not a hard and fast thing. It's like Captain Barbossa and Pirates of the Caribbean, more like guidelines anyway. What is the idea? The idea is that real money accounts don't trade with a mouse click. So if managers at Fido and Putnam and even places like those where I used to work, where you have to have a 2.5%, 3% allocation to a given name, and there's billions of dollars, you don't get into and out of stocks that fast. It's a real disadvantage relative to actually retail self-directed traders. But we had, at the hedge fund, we had positions that were $250 million worth of stock. So the reason I was always interested in waiting 3 days is because I want to see what people who have big positions, what are they really doing? They're not just going to blow it out one day, because it's not possible. It takes days, weeks to get into and out of positions sometimes. So the reason we give it 3 days typically is I want to see whether there's a knee-jerk reaction. Those are the people that are click trading it. And they're essentially trying to front run, in a way, what they believe the real money response is going to be. Nobody's going to sit there and try to hit a bid down 15, 20 bucks in Salesforce after hours or something like that, unless they really believe there's going to be some follow-through. You would never do that. So that initial reaction is the knee-jerk response of people who can use one of these things to trade their positions against people who can't. I usually like to hold on to a position for 3 days, or at least look for real evidence that real money is actually, going to try to get out of a stock, or is using it as an opportunity to get into it if the stock disappoints, and vice versa if it doesn't. In the case of Salesforce, the trade went our way. The trade was profitable. I apologize for not updating you. I'm actually out of the name now. We took our profits in that one, but this trade's still up, so you still can too if you want to. Okay, what else we got here? What could I do with buying and selling stock if I sold a put and company releases earnings and I want to restrict my losses in the aftermarket? After hours. Okay, so this is a very good point, because you can trade stock after hours, but you can't trade options after hours. So that could easily be some of the flow you're talking about as well. Bad news comes out, you're in a short options position, you are trying to cover that. The only mechanism you have to act is to hedge with the stock. That can help account for some of the knee-jerk response that you see in those after hours with the stock. That said, trading after hours in the equity can be highly problematic. So problematic, in fact, that actually one of the trading firms I work for, and I don't think the principals of that firm, who've subsequently kind of retired, I don't think they'd mind if I sort of said this rule, but we had a couple situations where traders, in those days, if you wanted to trade stock outside of regular market hours, we often would use ECNs like Instinet. Instinet used to be a machine, like a Bloomberg terminal was a machine. Instinet was a machine. We use those things. They had these green CRT screens, and you could actually, all the traders had to practice pounding orders into those things on these test symbols just to make sure that if a trader gave an execution trader an order, sell 50,000 XYZ, that they knew how to do it. And so they would always bang these things out. We found that we just never seemed to get that after hours trading right. That the knee-jerk response was almost always wrong. It's so wrong, in fact, that as a firm, we banned it. We actually said, you can't trade stocks after hours. Whatever risk you have, you're going to wear that until the stock opens and we figure out what's going to happen. A really good example of this, and actually my stories are probably too long, but Tyco, David Tice, ran a prudent bear fund out of Dallas. He was making allegations about Tyco back in the day when Dennis Kozlowski was CEO and Mark Schwartz was the CFO. And many months after that, he came out with this sort of bearish case. The SEC announced that they were going to do an investigation of their accounting practices. Stock was trading about 36.5 in the pre-market. It was about 8.15. And I watched that stock trade all the way down to $22 before the market opened. And it ended up opening around 26.5. So if you were trading that thing after hours, you could have very easily gotten beaten up. Now, granted, $26 is down 10 from the 36 where it was trading before. By the way, when you have big positions in a stock, you remember it clear as a bell more than 20 years later, as I do that morning. But in any case, after hours trading, a little bit sketchy, but if you really feel panicked about covering your short puts, yeah, you could trade the stock after hours. I don't recommend it. Okay, so what do we got here? Can you talk about how to trade zero DTE on SPX? Zero DTE, for those who don't know, 0 days to expiration options. It's not really zero DTE. SPX, I mean, it is, I guess, on the day that you trade it, but SPX, there are daily options available. And these things have really taken off. In fact, as much as 40% of the total options volume on any given day could be these options. So what to do? There's two participants that really trade these things actively, and they have really contrary sort of views on how to take advantage of it. So the first thing I would point out, and let's just take a look at where some of these options went out today. Actually, you know what? I'm sorry. I'm going to use, make sure I'm going to use, let's see, what can we do here? So I don't think I can put SPX into OptionPlay. Maybe we can just take a quick peek at my Bloomberg screen and we'll look at it there. Okay, so what are we looking at here? This is just the options montage. Today right here, tomorrow, day after. So they've got dailies listed. Things to think about. First things first. The closer an option is to its expiration, the faster it's going to decay. Its value is going to erode. And SPX options, that expire tomorrow, that is March 12th. So we're looking at the money straddle, closed around 51.18. So I'm just going to keep things easy. I'm going to look at the 51.20. 51.20 in SPX. So that thing's about $46, right? Maybe it's actually a little bit more. Yeah, so we're looking at 24 for the puts, 26 for the calls. Call it, yeah, there we go. We'll call it 50. So all of that extrinsic value has to go away. And this has only got about $2 of intrinsic value. So that's $48 worth of extrinsic value is going to erode between today and tomorrow. That's 1%, almost 1% of SPX's value. So some opportunistic investors will try to sell near dated premium to collect that accelerated rate of decay. But as the close of business approaches, more people, in my view, appear to be using these things directionally to make cheap flyers that you get a move into the close. I don't sell zero DTE options, even when they are slightly elevated as they are here. And I own longer dated SPX. So I've got some April 30 expiration SPX on as a hedge in my own book. And I'm very happy to sell. And I own that at probably 13, 14 vol. This is trading 18, 19 vol. So it seems like it's an easy thing to sell. The problem is that there's a lot of short gamma in that, and it's just very difficult to manage. And if that was all I had to do all day was sit there and try to collect some short dated premium, and I could be nimble about it, then I think that there's an opportunity there. And actually, I've seen that, some people, if you're thinking about making a directional bet at the end of the business day, so maybe 60 minutes to go to the close, and you think you might get a late session rally, I actually would favor using the short dated options in many cases over using the futures or the underlying for that. But again, I don't really do that kind of thing myself. So those are some ways that you could play it. And by the way to play that would be own some longer dated premium and sell the near dated stuff against it. You've defined your risk that way, and you're taking advantage of the accelerated decay. So if you're going to sell the premium, but only do that in the early part of the day when there's still some meaningful decay to collect. Because even though the pace of decay on those options prices is very high towards the end of the day, the absolute value of the options is very cheap. And you'll see those options. I've seen options go from $1 to 20 in the last 90 minutes of trading. I mean, that is a really, really difficult thing to do if you're going to try to collect premium. So close of business, playing a move one way or the other. I like to trade the zero DTEs from the long side from that. Wow, I have kept you guys for almost an hour. I'm sorry about that. I have a tendency to yammer on sometimes. This stuff interests me, and I hope it interests you. So, first of all, thank you guys all for watching. Thank you all for your questions. I try to get to as many of them as I can, and some of them we're going to try to preserve so that if we'll build up a library of interesting questions that we think are worth talking about in the future, and then we'll get to those. Like, subscribe, tune in on Wednesday at 4:15 when we're going to be back for more open mic. And if you are interested in learning more about OptionPlay, there's an affiliate link in there if you're not already a user, but I know many of you are. Thank you very much for watching.